Did you know when the Fed cuts rates, it doesn't actually mean your mortgage rate just went down? Here's what really went on. By the way, if you aren't subscribed yet, hit that little bell and let's stay in touch with the latest real estate news, commercial investing keys, and of course, build to rent knowledge that no one else is sharing. So here's the truth. The Fed just cut their rate by a quarter point. Big news. But that doesn't mean you or even I can suddenly lock in a cheaper mortgage tomorrow morning. The path from the Fed to your mortgage runs through something called the bond market. So today, I want to make this simple. I'm going to connect the dots so that even an eighth grader can follow it. And by the end, you'll know exactly what Fed rate cuts mean for single family investors, multifamily owners, and build-to-rent developers and managers like us. The Fed fund rate is the overnight rate banks charge each other. So think of it like the shortest loan in the world, just 24 hours. Easiest way to picture it. It's the gas pedal of the economy. Push it down, cut rates, you're trying to speed things up. Ease off, raise the rates, you're slowing things down. That move shows up right away in, of course, credit cards, auto loans, and business credit lines. Fast, short-term money. That's where the Fed is in control. But mortgages, that's not short-term. That's the 30-year road trip. And the Fed doesn't steer the car directly. Mortgages are priced off the bond market, which we discussed before, specifically the 10-year Treasury yield. Why, you ask? Because mortgage lenders want to know, if I lend you money for 30 years, what's the inflation going to do? What's the safe alternative? So they look at the 10-year Treasury, the safest, most liquid long-term debt in the world. Mortgage rates usually sit about 1.5 to 2 points above that yield. So for example, think about this. If the 10-year Treasury is at 4.5%, your mortgage will probably be around 6 to 6.5%. That's the spread lenders need to cover the risk and operations. So remember that. So who are bond investors, you ask? They're the people lending money to the U.S. government by buying treasuries. Okay, let me say that again. They're people lending money to the U.S. government by buying treasuries. Here's where it gets simple. When lots of investors buy treasuries, prices go up and yields fall. When they sell treasuries, prices fall and yields will climb. So think of it like a seesaw. Investor pile on one side, yields drop. They run off of it, yields will jump. And what makes them move, you ask? Well, it's inflation expectations. If they believe inflation is cooling, they'll fine with lower yields. If they think inflation is heating up, they demand higher yields. That's why Fed cut matters. A cut is a signal. We believe inflation is under control and we're supporting growth. Bond investors take that signal, adjust the yield, and that trickles into the mortgages, which we believe they will. So here's the domino effect. The Fed cuts rates, signals they think inflation is cooling, which based on the data, we are seeing that. Bond investors will react to this. They will buy treasuries, yield will drift down, then mortgage lenders will reprice off those yields. Okay, so that is your 30-year fixed rates, and those will follow. That's why when the Fed cut recently, we saw an average mortgage dip into the mid-sixes, with talk of breaking below 6%. So if more rates come, which I think they will. So no, Jerome Powell doesn't pick your mortgage rates, but he tips the first domino that gets us there. So why does this matter for real estate investors? Let's bring this on home. Why does it actually matter if you're in real estate? Well, let's talk about single family. A dip in the mortgage rates may tempt a few renters to buy, a few, but the cost gap is still huge. Owning is nearly double renting in many markets. We're seeing that here in Utah, Arizona, and Idaho. But rental demand will still hold steady. Multifamily, well, lower financing costs means refinancing becomes realistic again. And we all know that those multifamily investors are looking for that. Now, the cap rates will compress, and this is exciting for us. It's about time that we're getting to this point, which means asset values go up. And in build to rent, this is the sweet spot. Developers like us and the partners we work with means cheaper financing on both construction loans and permanent debt. That's very important. So while the demand for rentals doesn't really shrink, that's the 1-2 punch that makes BTR so attractive right now. So looking ahead, what could the future look like? If inflation keeps trending lower, the feds keep trimming, bond yields will likely fall further, and mortgage could slip under 6%. When that happens, mark my word, more buyers will re-enter the housing market. We're kind of stale right now. More investors refinance and reposition, and developers building BTR, multifamily communities, have a clear runway to bring new communities online. So here's the bottom line. Fed cuts don't instantly drop your mortgage rate. So just get that out of your mind. But they start the chain reaction through the bond market. Follow the bond market closely. That shapes every corner of real estate finance. So if you're in single family, multifamily, build to rent, knowing this path helps you time your strategy. So what are you doing right now? Are you timing it? We are. So I want you to drop your thoughts in the comments below. Are you changing your game plan with the Fed pivot? Are you waiting for the rates to drop, or are you planning now? Are you making those deals happen? And if you want to see how we're navigating BTR deals and our pivot right now, I want you to go ahead and just grab our case study at coreybono.com/case study. And if you like this video, I made another one right here that may make all the difference in your next investment. It may not, but you won't know until you try it.